I'm Howie Lim. This is Money Hacks by the Business Times. The dream of building a lasting enterprise often consumes business owners. They pour unmatched hours, years, and capital into their building. It's their livelihood, legacy, and frankly, their identity. Yet amidst this dedication to growth, a critical question frequently goes unanswered. Will you be financially secure when it's time to step away? Many depend on selling their business to fund retirement, a highly speculative strategy that relies on perfect alignment of the market, buyers, and timing. And what if you don't want to sell just yet? The financial stakes are exceptionally high. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And we spoke to Grace Tay in episode 249 in this series about exactly this. But that was with the focus on business owners gearing up to sell. So today, she joins us again to discuss if you're not ready to sell, but still want to take a step back, what can you do? Grace, always a pleasure to speak.
Great to be back. Thanks, Howie.
The last time we spoke, you talked about this 30-50% reinvestment rate because of balancing reinvestment and extraction, right? What's a practical risk-adjusted formula, though, for an SME owner to set the annual personal extraction target, especially in years where cash flow is quite volatile?
I would say pay the business its oxygen, pay risk its premium, and then pay yourself. You mentioned volatility. That's very normal in Singapore. When it comes to extraction, rather than a fixed and rigid policy, I would recommend a more variable one that flexes with conditions. 3-part process. So the first would be to cater for operating oxygen, 3 to 6 months of operating expenses that adjust for seasonality as well as debt obligations. So this would be the working capital of the business, not so much profits yet. The second part would be payment for risk premiums. So these are the safeguards that can prevent a one-off event from derailing the SME business entirely.
Yeah.
So these one-off events could be things like key person risk, death or disability to the founder, a lawsuit, or even perils such as fire, flooding. And then finally, allocations to business growth. So the budget that the business sets aside for expansion and for scaling, once the risk premiums as well as operating oxygens have been accounted for, things like investment into inventory, marketing, capex, and so on. Extraction formula would be free cash flow minus those 3 things that we talk about. So operating oxygen, risk premiums, and budgeted growth. Whatever's remaining then in a good year, it could be 100% of this extraction of true surplus. Because one of the key risks in business is that of concentration. So if we treat the business as a single holding, then it makes sense that once the business is adequately funded, we should redirect resources to non-business related assets.
Yeah. Speaking of this concentration and the personal liability risks that are really unique to SMEs, what specific non-business asset structures are most effective, legally speaking, to separate personal wealth from the blast radius of the business?
There are 2 firewalls for personal wealth. The first would be a limited liability legal structure, and the second would be how a business owner can structure his or her own personal assets. First and most important line of defense is the business structure. Incorporating it as a private limited would establish the business as a separate legal entity. So this then limits creditor claims to company assets and not personal assets, because creditors cannot then pierce the corporate veil to claim on personal assets. Unlike other structures such as a sole proprietorship or partnership, which doesn't distinguish between business and personal assets. That said, limited liability is not a magic cloak, because there are situations which still exposes directors to personal liability in the event of fraud or wrongful conduct or abuse of corporate formalities. So in these instances, the directors themselves could be personally liable. So what this means is governance is equally important, not just incorporation. And then the second firewall that I mentioned in terms of asset structuring, right?
Yeah.
The key principle is to keep personal investments and property outside of business structures. So remember the principle of the two wallets that I mentioned the last time. So business wallet and a personal wallet, keep it separate. If, let's say, the business owner wishes to ring-fence assets from the business through a structure, what they can consider is a trust structure. However, trust structures needs to be set up early and not when the smoke is already in the room.
Yeah.
So the reason for that is because insolvency laws can unwind any last-minute transfers into the trust. For example, in Singapore, personal assets are only shielded from creditors if they were transferred into an irrevocable trust, that's the first thing, with a minimum of 5 years before the event of bankruptcy.
Oh.
So if a business owner explores an offshore trust structure, the timelines can be more lenient, but that said, it also does not protect against existing creditors. And then the final thing I would say is there are certain assets in Singapore that are inherently protected from creditors. Things like HDB, CPF funds, insurance policies that are placed in express trust for the owner's spouse and kids. But if you think about it, this probably only forms a fraction of a business owner's personal assets.
Last time we spoke, we also talked about how the strategies may be different for growing SMEs versus mature SMEs. Let's say a mature SME owner optimizing wealth preservation. What percentage shift in portfolio allocation then from a core global equity bond mix to less liquid alternatives would you recommend? I mean, what's the key due diligence step that they often miss?
I always say that the best investment that you should have is something that you can hold through stress. And depends very much on the individual's risk appetite as well as need for liquidity. The important thing to always remember is that low liquidity doesn't necessarily mean higher returns. It really depends on the purpose of the investment itself. If the objective here is for wealth preservation, the priority is stability. We look for assets that have a low or negative correlation to the market. And some of these assets, they do sacrifice higher returns for that stability. So for example, bonds. That said, if the objective is wealth preservation, then returns would be a secondary priority. So some alternatives would be things like gold, commodities, investing into royalties, and even private market assets such as private credit, private equity. These alternatives tend to be lower in liquidity versus your traditional public markets because pricing is less transparent and trading volume is also lower. So I'd say a 10 to 30% allocation is reasonable once cash flow is stable and the need for liquidity has been addressed. You also asked about due diligence and what is a key step that people often miss. A gap often lies when people assess private market solutions, and that's because private markets tend to be opaque. Information is less accessible, and the returns from private market investments depend very much on the quality of the fund manager, their deal flows, the access, skill sets, as well as the level of due diligence they make before they include an investment into their portfolio. The general sentiment in the market is that private market investments tend to be more risky, and that's because good managers are hard to find. But if you do find a good manager, you can be very handsomely rewarded. So for example, last year, my clients and I at finexis, we had the chance to invest alongside Temasik's private equity arm, Azealia. That investment has actually returned very strong double-digit returns in the 1 year since, with zero market volatility. Now, that said, it came at the expense of an 8-year expected loss of liquidity.
Yeah. Still to come, what about the risks of sector-specific downturns? What should SME owners do then? More with Grace Tay from finexis in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. Speaking of liquidity versus, say, tax smart strategies as well. The last time we spoke, you talked about tax efficiency with regard to SRS and CPF top-ups and such. For an owner in the highest income tax bracket, should the first priority for extracted personal cash flow be maximizing these vehicles or, say, funding a liquid emergency buffer outside of the business?
So I'll use the analogy of a house. So imagine if today you got a new house and you're looking at outfitting it. What is the first thing you would do? Would you install the lock first? Or would you go out and look for energy efficient lighting?
That is a good point. I never really thought about it that way.
Probably the lock first.
Yeah.
Right? It makes sense because without the lock, then everything else in the house is compromised. It's at risk. And that's what the liquid emergency buffers are for, the lock. That said, whether or not a liquid buffer is necessary for the emergencies that we are thinking of really depends on whether there are more efficient safeguards that we can put in place to address those risks. So for example, if we are thinking about a health risk down the road, it may not make so much sense to set aside a pile of cash just for some unidentifiable probable illness in the future. It might be more optimal to invest a sum of monies into a comprehensive hospital or critical illness plan. But once those safety nets are in place, then we can look at optimizing for tax expenses. For an SME owner at the highest income tax bracket, it usually makes sense to leverage this tax-efficient strategies such as contribution to SRS or CPF. Then again, it's also important to understand liquidity needs because these contributions are also one way. You won't be able to access that monies until later in life.
Right. What about the pitfall of owner dependency? What if, say, the owner hasn't formalized that middle management? What's the single most critical, non-negotiable SOP or documentation, if you will, they have to create today to immediately reduce that dependency risk, especially if they never plan to sell?
I think even if the business never plans to sell, owner dependency is still a very real risk because life happens. There could be death or disability or family emergencies. So the single non-negotiable SOP is to have a succession plan because a succession plan is not a sale plan. It's a business continuity plan and comprises 3 pillars. First, outcomes and decision-making rights captured in black and white. So the business should have a shareholder agreement that states what happens should a trigger event occur, who takes over roles and responsibilities, how shares are to be transferred, how shares are to be valued for that transfer. Then the second pillar is funding arrangements. So if shares must be transferred, where does the funding come from in order to compensate the late owner's family without forcing a fire sale? So I'll say these 2 pillars are some of the most important as part of a contingency plan for the business because one of 2 situations could very well happen. The first is the business is doing very well at the time that this personal tragedy happens. So what could then happen without a proper protocol or SOP to valuing the shares? It could result in the family holding the business ransom if there isn't an agreement as to what's a fair value for that transfer of shares. Operations could be stymied because decisions cannot be made. Or the flip side could be true. If, let's say, the business hits a rough patch just as this tragedy happens, the family could be holding on to shares that are not worth very much. And the remaining shareholders could then unilaterally decide to cut the family out from any returns, change the dividend policy. After all, they hold the keys to the operations. There's no protocol to govern these things. And that would then leave the family with a triple loss, right? Loss of a spouse, loss of a parent perhaps, and then loss of an income, now, which would be a terrible situation. And then the third pillar to this succession plan would be an operation run book. Things like banking mandates, access to passwords, supplier, customer contracts, payment approval flows to ensure that the business can continue running without the owner. So I always tell owners you don't need a 100-page manual. You just need a single plan that prevents a personal tragedy from becoming a business collapse or a family crisis.
Grace, earlier we were talking about having not formalized middle management. What about the SME owner needing to quantify the hard cap for injecting personal funds back into the business? And maybe there are professional third-party accountants who should be involved in enforcing that limit. What do you think?
I would say this is a very personal decision and often an emotional, not logical one. For business owners, many of them, they take a lot of pride in their business and they feel a huge sense of responsibility towards the business. So they would typically do whatever it takes to keep the business afloat, so long as they think that it can pull through. So for example, I had a client who at one point in time stopped her own personal investments because she wanted to redirect her own salaries to pay employee salaries because the business had hit a rough patch. I think the key principle would be to default back to the 2 wallets. Try as much as possible to keep them separate, the business wallet from the personal wallet. But if, let's say, an injection is required, it needs to be accompanied with a written business plan that states how the funds will be used, for how long, what is a KPI that measures recovery. And if that deadline comes and goes and the KPI doesn't show signs of improvement, perhaps we need to stop the injection or consider restructuring. And it's helpful to have a third party come in to enforce that requirement. So this third party can be a company accountant, like you mentioned, or company secretary or CFO. And frankly speaking, the owner's spouse or family counsel because household assets are involved. The key principle here is that the act of saving the business should not end up sinking the family.
Yeah. Speaking of, the business is the engine that fuels retirement, is what you said the last time. So how can an owner then structure their business's balance sheet to make it a more reliable, predictable source of dividend income rather than this lumpy source of potential sale proceeds?
Two things need to happen. The first is predictable cash flow, and the second is a distribution policy. Predictability turns very much on improving the business fundamentals. So having more recurring revenues, disciplined pricing, tighter receivables, cost controls, and so on. Once you have that predictable cash flows, then the next step would be to implement a distribution policy. And I would fall back to that 3-step process that we discussed earlier. In practice, what this looks like is maintaining a minimum cash buffer for working capital, setting aside for risk premiums as well as for essential growth of the business. And then whatever remains, there could be a policy where you extract a consistent percentage of that free cash flow as dividend income for the owner. End of the day, business is still work. So if the business owner desires something that is a truly passive retirement paycheck, I would suggest a 2-engine system. So the first is to have healthy and predictable cash flows from the business, but at the same time also to have a personal portfolio of truly passive assets. Things like your rental from property or investment income from bonds, dividend, equity. Because it's this second engine that gives the business owner the option to step back from the business eventually without his or her lifestyle having to step down.
This does not sound possible, though. You talk a lot about, predictable cash flow, etc. Earlier, we talked about the volatility of cash flow. So there are certain risks, sector-specific even, that can we even predict? I mean, what simple metric should an owner track annually to determine if maybe their business has become too large a component of their total net worth?
I would apply the principle of diversification that we use in general stock investing, which suggests not more than 10 to 20% allocation to a single stock as part of someone's overall portfolio. So apply the same approach to business because end of the day, a stock is a business, right? So for listed companies, it's easy to quantify the business equity value by looking at the share value. So if that's the case, then business shares should not form more than 20% of the owner's overall portfolio. However, for many SME owners, the business is privately held. So the main value of the business comes in 2 aspects, the cash flow as well as the future potential sale value. If the owner's personal goals are heavily dependent on these 2 aspects of business value, then it is time to take a hard look at the extraction policy as well as how much is diversified to non-business assets. Because if we don't do that, then the household cash flows, future finances turn on one of 2 things happening. The first is either the business must be sold someday for a good value, or the owner needs to continue working forever in the business, neither of which is either fully controllable or ideal.
You know, Grace, how they say the best time to prepare was yesterday, and then the second best time to prepare is today. But what if an SME owner hasn't prepared? How long, in your experience, have you seen it take for one to get prepared?
Okay, I would say when there's a will, there's a way. So it depends on how committed the SME owner is to get everything in place, legal structures, safeguards, and all of that. If the owner is 100% committed to it, within 1 or 2 months, all the paperwork can be done. The longest turnaround is usually in terms of quotations, commercial insurance, fire insurance, and all of that. But in terms of setting out the succession plan, in terms of setting out the legal paperwork, the shareholders agreement, if let's say everybody is collaborative, usually these things can be done as quickly as you want it to be done. I would just add that it's usually best to get all these things sorted when the stakes are low, because if this can't be agreed upon when the stakes are low, it's going to be impossible to agree when the stakes are higher.
Grace, it's always good to speak. Thank you for your insights today.
Thank you, Howie.
This has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.